Good morning, ladies and gentlemen. Well, I want to keep this brief because next week is going to be absolutely pivotal, and I'll give you the reasons, and I've also written down what my triggers are going to be. The triggers are going to be in the QRA, but let's have a quick look at what the model is saying, and I'm afraid it's not very much. It's basically saying that if things get worse over the next couple of weeks, it's going to go into risk off. And probably it's going to go into very strong risk off. But that is basically tautology. It's saying that, if the QRA is bad, things are going to get very bad. Okay, but we know that. So the model here is of no help. And I will now go through the reasons why. To me, the key chart to understand is this one, the term premium on a 10-year zero coupon bond. So here we are at August the 4th. We all know the QRA was August the 2nd. Here we are August the 2nd, and it was basically minus 20 basis points. The QRA and the huge increase in issuance that we had in coupons made it go from minus 20 to the current about 37. So let's call it 50 odd basis points. The key question becomes, is this a high term premium? Well, it's a high term premium if you look at the past 2 or 3 years. If you zoom out and go back all the way into the 1990s or the 1980s when the deficits were very high, it's a completely different picture. This actually is a relatively low term premium. We could easily go into term premium around the 1% area. That is, given the size of the deficit that needs to be financed, this would be not ridiculous at all. So the question is, does the Treasury wish to keep this term premium low and switch as much of its issuance as it possibly can to bills as opposed to coupons? That's almost a political decision rather than an economic one, but I would argue that if they do that, yes, they will goose the markets for a short period of time, but they'll make it incredibly harder for themselves over the longer term. Basically, to me, then the US becomes another emerging market story. Just, a bit like what people have been arguing about the UK for a while, that it just became an emerging market country behaving like an emerging market country. Well, the US will have done that too. To me, if they do that, yeah, they'll goose things by a few percentage points for a while, and they will delay the inevitable, but the inevitable is still coming. I think the professionals at the Treasury are going to argue that this is still a very good deal for the US taxpayer, and that they should maintain the ratio and proportion of bill issuance to coupon issuance at the levels that TBAC suggests, around the 20%. Now they're 22. Can they take it to 25 without consequences? For sure. Can they take it even higher? Yes, in the short term, but in the long term, no. So to me, next week becomes a very important week, and that is why I want to keep this short, but give you the triggers that will show you where we're going to next. The markets have an amazing ability of being at very critical levels just as really critical events take place. Now, the 2-year note and every other component of the yield curve is at critical levels, and as you know, these levels have been here for weeks, months, in some case years and decades. And here we are, the 2-year note bang on at 5%, between 5 and 5.25, ranging up and down, going nowhere. I think the 2-year, even with the QRA, is going to remain pretty static. I would be very surprised if next week we are a million miles away from 5% by the end of the week. But what will move for sure are the things where the issuance will be discounted, and that's 5s, 10s, and 30s. 5s, very much stuck around this 486 level. What do you want to do? A couple of basis points up, a couple of basis points down. If the QRA is bad, we are going straight up here. We're going straight up towards this 520 area without touching the sides. If the QRA is good, we are going to bounce off this 449. So we will be a good 25 basis points away in 5s, 10s, and 30s by the end of next week, depending on what is coming up. Here we have the 10s. Next week we either trade 458 or we trade up here, 520. And 30s, again, either we're here at 472 or we are here at 526. If I take this and change it to a monthly chart, you will see how important this, this level it was, but how important this 525 level is. And beyond that, we have nothing until we get to the, an incredible, for people who have never traded 30 years, of 585. These are, absolutely crucial levels, and next week we decide. I've written a piece on what the QRA is and what my triggers are, and that is included in the summary sheet. There's a link to it. I don't think there's any point in me going into the minutiae of, where it's going to trade, because whatever it is next week, that's where we're going. We're either going to 470 to start off with, or we're going up to 525. As simple as that. And that is precisely what the yield curve is saying. This is now a weekly chart of 2s, 10s. If they're going to issue a lot of coupons, we are going to disinvert, and we're going down to this kind of level. We're talking about minus 35, and we're now plus 16. So 2s, 10s are saying we're going to have a nearly 50 basis point move, and that is what I suggested in the outrights. It's going to be a big move in the outrights, which is going to have a big move in the yield curve. And if they switch back to bills, we're going to go back here to at least to 48, if not to, something like this, 62, 63. And that is what the yield curve is saying. They issue a lot of stuff for Q4 and Q1 combined. You are going to see basically a positive yield curve. 5s, 30s, much the same thing. Either we go back to zero, or we start breaking these levels, and then you're looking for something like this, which is minus 50, another 25 basis points. Big moves are coming. Absolutely massive moves are coming in the bonds. Don't be surprised to see 3, 4, 5 big figure moves in UB. And that is all that one can say. The market is literally poised on a knife edge. It's going to go one way or another. I don't think these are going to be small volatilities. And here you have a weekly chart of the MOVE index. I think by the end of next week, we are either down here very close to 100, or we are busting through and we're going towards the 155 area, 160. I really can't see anything in between. So even volatility in bonds tells me that it's going to be, sort of an incredible move that is going to shift the yield curve either to positive, i.e. disinversion with all the signals that has, or we basically revert back to mean down to here around the 100 area, and that has its own implications because that means that people will be selling puts like crazy. They'll be selling out of the money calls when the market gets to where it needs to, and therefore volatility is going to collapse in the bonds, and we will be trading new ranges, new tight ranges at different yield levels. This is now a weekly chart of Germany against the US, and here we are, we closed exactly at 202. You know, the market has this incredible ability, and I've seen this over and over and over again, to be at absolutely pivotal levels just as it waits for the news to break. As you can see, this is going to go big time one way or another. Now, the fact that it's at the weekly Bollinger Bands on the the upper Bollinger Bands or the lower Bollinger Bands, whatever chart you look at, a monthly or a weekly, would suggest that if you were a gambling man, you would say that it goes down, and it goes down back again towards 172 and this middle Bollinger Band. But to me, the risk reward is actually to wait to see what the number is and probably be slightly more aggressive on the downside than on the upside, knowing that you are already at the top of the Bollinger Bands. I don't know what the QRA is going to say. I've given you in the summary sheet a link to what my personal expectations are, but those mean nothing. I just know that if there's a lot of issuance, the market has probably discounted a good deal of that, because let's face it, nobody's going to get caught with their pants down twice in a row. No serious player, and there are very many serious players in the bond market. So to me, the risk reward actually is to the downside. But if it starts breaking these levels, that is an acceleration, and that will have an impact on all assets. That will be saying that the spread is probably going to this kind of level, another 30-40 basis points. And if that is the case, you are, every chart is telling you the same. Yield levels are going to be very different over the course of the next couple of weeks. Because if we're going up here towards this 230 level, and you can see when we break, we don't stop. We have a trend, right? We have a really good trend. And, this kind of level is certainly not out of the question. And that's another 35-40 basis points. And that tells you that that move is going to come primarily from the US bond side. And that is a big thing, because it's telling you don't be surprised by bond yields 50 higher or 50 lower. And that naturally is going to have a massive influence on all the assets we look at. So now this is the butterfly with the bunds at the center and US Treasuries and the BTP on the outside. And you can see that even that is at absolutely critical levels. Look what happened here. I mean, you can forget about the Bollinger Band. It just went, how much did it go? It went 100 basis points, 120 basis points in 3 weeks. So that is why, it means absolutely nothing that we are at these Bollinger Bands. It says that the odds are that we go that way, but it means absolutely nothing if the numbers come out and they're going to issue another 150 to 200 billion more in Q1. The term premia is going to go higher, and therefore the rate on the 10-year note and on every other market that has a high issuance coming up, like the BTPs, it's going to have the same effect, and we're going to be absolutely crashing through these levels, and we're going to go down here. So, to get down here is another 90 basis points, and that is a big, big deal. And, if you look at the Italian bond against the German bond in isolation, that basically tells you that we are going to be trading about here 228, if not even higher, 230s, 240s. And how do we get to this? Well, it's a combination of bunds doing not very much, BTPs getting slaughtered, and the 10-year note getting slaughtered. So you're getting the picture. Everything we look at in bond world is at absolutely crucial levels, and yields, mostly in the US, are going to be very, very different by the end of next week. Extrapolating that to DXY means that we find out next week if this period here, which basically is from the end of September, is just a flag which breaks upwards with the yields in the US, and then it goes to something like 109. You have this 109.29 area. It should reach it very, very quickly. That is what it's saying. Or, conversely, we go down to at least these kinds of levels, which is around the 104. But what it's telling you is going to be volatile. So a break of this goes up to 109.30 very quickly and probably exceeds it. Or we start really breaking down, and then you're looking for the, low 104s. I don't think there's anything in between there. Extrapolate that to Euro USD, you are either looking for this 200-day moving average around the 108 area, or basically you're looking for a complete breakdown here, and you are looking for 102 very, very quickly. I don't think there's very much in between the two possibilities. Now, gold, it's interesting that so many people are pushing back on my real yield story. And the one thing that does make sense is that a lot of countries, let's call them, Russia, China, etc. I mean, basically all the countries that are not aligned with the USA are afraid that some kind of a conflict is coming with the USA, and they don't want their assets to be confiscatable by the US, and therefore they are shifting their composition to gold as opposed to US treasuries or real yields or anything like that. They are completely insensitive to price. They don't care. They're just going to buy gold even if it's at 5,000. Okay, I mean, that's a possibility. And it's not a possibility that I can quantify, but I know that I live in the US or I live in the West, and therefore what the Chinese do, I couldn't really care less. I would much rather get 2.5% real rate of return in US dollars than hold a shiny piece of rock that I can't do anything with. If the US wants to punish them, they can, regardless whether they hold gold or anything else, because they'd have to hold physical gold in China. Okay, good luck with that one. I mean, I don't want to play on the upside in gold, because to me it just makes no sense. I'll be wrong. How will I know that I'm wrong? Well, it breaks 2045 for no reason whatsoever. And then, it keeps on going. I think at 2045, if it's there for no reason, probably you want to start buying volatility in gold if you want to trade gold, because it just means that something abnormal is going on. It's not at the moment a real yield story. It's not a dollar story. If we get a very bad QRA next week and yields start going up a lot, and real yields will spike with them, not as much as nominal yields, but they will go up some, and the US dollar is incredibly strong and goes up 2-3%, and gold does not come down, then we are at some kind of a different narrative for gold. Whether the one I've just told you is correct or not, I have absolutely no idea, but I will recognize that we are at a different narrative because this should not be happening. And when things that shouldn't be happening happen, then they have a tendency and a habit to go a long, long way. Because it takes a lot of time for people to stop fighting it, and then it takes even longer for people to start understanding it, and it takes an eon for them to finally embrace it. And by that time, it could be way over this level, 2,200. So I'm telling you, I don't know. But if next week we get a combination of higher rates, higher dollars, and gold is not going down, something different is happening. The odd thing to me is that the geopolitical tensions should be being reflected in oil just as much as in gold, and that is just not the case. Here you can see that the gold to DBC price actually is favoring gold. Gold is rising against DBC, and it could rise quite a bit further. And if I actually enlarge this chart for you, you can see how volatile it can be. It can easily come up here, to 820. And that is the odd thing about this. Why is oil not being preferred, or DBC commodities in general? And let's face it, DBC is 60% oil. Why is that not being favored to gold? I just don't know. I have absolutely no idea why that is happening. To me, oil makes far more sense. It's just that it's not happening, and that gives me a lot of caution about gold, because it tells me that it could go up another 10% against oil. And if oil does nothing, that's another 200, easily another $200 an ounce on gold. So I'm very weary. I can't say that I understand it, but there you have it. Looking at DBC in isolation, it's holding this 24.39, and therefore at some stage I would expect it to start threatening this 26.93 level, and that is probably a level that is going to find it very, very hard to break. But to me, the risk reward of being short DBC here is not great. While gold is doing what it's doing, and unless it starts coming down, I really can't see that DBC is at a big disadvantage. You really should expect it to trade up here, especially if something geopolitically bad happens. And I just wanted to show you this spread of ETA, which is the defense and aerospace ETF, as a percentage of SPY. Now, people who have been with me for a long time know that we made quite a bit of money trading it to the upside in 2022. Look at it. It's at the same level, i.e. at the lows of where it was when we got the COVID episode. It's really gone nowhere. And in the meantime, we've had Ukraine, and we've had now the Middle East. Okay, so we've had this little response here for the Middle East. But if you look at the longer term picture, it's not a chart which is telling you that there is a huge kind of geopolitical problem in the world, because this should be a completely different look. The 200-day moving average and the 50-day moving average and the 100-day moving average are all pointing downwards. ETA against SPY has to start establishing itself up here at the very least, to start getting a look that says we have a geopolitical problem, and people are buying arms because they're afraid and they need to rearm and there's going to be a war. Uh, this is just the wrong look. So I think if you think that you have geopolitical problems, rather than buying gold, you start buying ether and hedging it with SPY. Uh, these spreads just don't say to me that we are in a period that is going to be a geopolitical problem, much more a rate problem and a US deficit problem than this kind of geopolitical one. My clean SPX chart basically says volatility ahead, because you can see the real support is going to be here 39.83 to 39.34, and you can see that every time we have broken through these kind of levels we've been able to go quite a bit further down. I think there's very little that if the QRA is bad, you're going to go down to this area, and if the QRA is good, you rally at least to 42.55, at least. So volatile week ahead. That's all that can be said. Let's have a look at the VIX. I think there's very little in between a break of 22.80 and then probably this kind of behavior towards 25, or we just collapse all the way down into the sort of low 17s. So very little in between either scenario. Let's also have a quick look at a monthly, because we will be closing the monthly bar, and then we get a very, very interesting look. This is the 200-month moving average here. It really is a big deal. We start closing the month below 41.81, we are in a new range to the downside, and that will tell me that the QRA is coming, but if that is bad, I don't think that the support is really until the this kind of 38 something. It's very easy to get there, and if we actually zoom out again, you're looking for a big move. You're looking down to this line is at 37 something. So yeah, you're looking to have a negative performance for the SPX on the year. It all depends what the QRA is, and so many people are bearish. I don't know. Let's see what the QRA is. But what I'm saying is that whatever it is, the moves are going to be big. Because if we now start zooming in again, I think there's very little likelihood that we don't go and test these lines up here. And that's like 4,200 again. So we're looking for moves of at least 3, 4, 5% in the S&Ps in a very, very brief period of time next week. Let's have a look at the NASDAQ, because that is fun too. I mean, bad QRA, at the very least you fill this gap here, which is down to 13,600, and probably this gap down here, which is 12,800. So you're looking for big moves in everything. To me, it's obvious that if the QRA says that we're going to issue another 150 billion on top of the ones that they said on the August 2nd one, I don't think the market can take it. I mean, the market can naturally take it, but it's going to demand a higher risk premium. And that risk premium in bonds has to be transmitted to equities. And not only does it have to be transmitted to equities, but also then the multiplier in the equities has to be reduced, and also the earnings expectations for the next couple of years, which, don't forget, we have 25% increase in earning expectations for 2024 and 2025 baked into the price at the moment. Can that possibly be sustained if 10-year notes are 5.5%? I don't think so. I think we have a big move. And that is why the possibility of them, giving the market a reprieve and causing a rally in all assets by issuing far, far more bills than treasuries is a political possibility. We don't need to anticipate this because you can see how big the moves are going to be. It's going to be far more profitable to wait for the announcement, do the calculations. We should have them within 5-10 minutes of them coming out. And even if the market's moved 1% in the right direction by then, you still have another 2 or 3% to go. So I think the smart thing is to wait until Monday, see what the numbers are, get a very good indication of what Wednesday is going to be, and be therefore ready to pull the trigger on Wednesday. I haven't even mentioned the FOMC because A, they're going to do nothing, and B, I just can't see what Powell can say that is going to negate what Yellen has done. What can he possibly do on Thursday? Is he going to cancel QT? No. I just think that the FOMC is completely irrelevant this coming week. They're not going to do anything, and even the probabilities of them doing something over the course of the next two meetings, i.e. the one going all the way into January, are below 50%. So basically what the Fed is doing is they're taking themselves out of the picture, and it's now all up to Janet Yellen. Good luck with that one. But here we are. I've changed all the levels, and I bet you they will, one of those extreme levels, if not both, will trade next week without a doubt. And this is the link to the very short piece I did, because there's very little to say. The number is the thing that matters, and we will know the number by, 5 minutes past the release on Wednesday. And we just act on that. We pull the trigger in all the assets, and good luck to us. Thank you very much indeed. Have a wonderful weekend, and tweet you tomorrow.